Debt mutual funds are often credited with carrying lower risk than equity funds. But the word is lower risk, not no risk. We invest our money in debt funds for various reasons: portfolio diversification, meeting shorter time frame financial goals. But these benefits don't come without their share of risks that investors always take on when investing. The aim of this video is to make investors aware about the different kinds of risks debt mutual funds carry. Interest rate risk, risk to the price of a fixed income instrument as a result of change in market interest rates. In simple words, most fixed income instruments that debt mutual funds invest in carry a fixed rate of interest. If the market rate of interest goes higher, new fixed income instruments will reflect that higher interest rate, which means older instruments will lose their appeal. Simply put, if interest rates go up, prices of fixed income instruments, and by that regard, debt mutual funds, will go down. However, as we mentioned in our previous videos, not all debt instruments react that way. Longer duration instruments have a higher interest rate risk than shorter duration instruments. During such times, you may consider investing in dynamic bond funds, which invest across different durations. Next is credit risk. Debt funds invest in fixed income instruments that are issued by different companies and institutions. During the life of the instrument, the issuer or the borrower pays interest and at maturity the principal. However, it may happen that the borrower is unable to make those timely payments. That is exactly what credit risk stands for. Low-rated bonds may offer better returns but are likely to default. Debt fund holdings are categorized based on the credit ratings given by ratings agencies, AAA, AA+, etc. If you'd like to manage this risk better, invest in funds that have highly rated fixed income instruments. You may also invest in gilt funds that invest only in government securities and carry zero credit risk. Next is liquidity risk. This refers to the risk of not being able to liquidate or sell when the time arises. This may happen if there is a low demand for that particular instrument. Many securities are traded on the debt market. Some could see a drop in their liquidity, which could occur due to various reasons like issuer-specific problems, overall economic environment, etc. This is known as liquidity risk. From an overall debt fund perspective, close-ended debt funds may have a higher liquidity risk than open-ended, which can be redeemed anytime and hence carry lower liquidity risk. Next is reinvestment risk. As the name suggests, this risk brings in the question of where to invest next after the fixed income instrument matures and releases the proceeds. This risk is heightened in a falling interest rate environment because money that was parked in high-yielding instruments is now released and the fund manager will have no choice but to park it in a low-yielding instrument. Long-duration funds could do well in a scenario of falling interest rates as they help lower the reinvestment risk. These are some of the risks debt funds carry. To manage these, one of the best strategies is diversification across maturities. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.